Good evening, everyone, and welcome to the Tata Communications earnings conference call for Q3 FY24. We are joined today by our MD and CEO, Mr. Amur Lakshminarayanan, our CFO, Mr. Kabir Ahmed Shakir, and our head for IR, Mr. Rajiv Sharma. The results for the quarter ended 31st December 2023 have been announced today afternoon, and the quarterly data pack is available on our website. I trust you would have had the chance to look at the key highlights. We will commence today's call with comments from Lakshmi, who will share his thoughts on the business and long-term outlook, followed by Kabir, who will share his thoughts on the financial progress achieved. At the end of the manager's remarks, you will have an opportunity to get your queries addressed. Before we get started, I would like to remind everyone that some of the statements made or discussed on the conference call today may be forward-looking in nature and must be viewed in conjunction with the risks and uncertainties we face. A detailed statement and explanation of these risks are included in our annual filings, which you can locate on our website www.tatacommunications.com. The company does not undertake to update these forward-looking statements publicly. With that, I would like to request Lakshmi to share his views. Over to you, Lakshmi.
Thanks, Chirag. Welcome to all of you for the third quarter FY24 earnings call. This being the first call for the year, want to wish you all a very happy new year. We're very pleased to share that our reported revenues grew by 24.4% year-on-year. Our reported EBITDA is up by 5.3% year-on-year and 11.7% Q-on-Q. Our adjusted PAT, excluding the exceptionals, was up 13.9% Q-on-Q. Further, we're very happy to report that our quarterly revenue crosses the 5,000 crore mark, and our data revenues crossed the 4,000 crore mark, coming in at rupees 4,618 crores, and was up 15.6% Q-on-Q and 28.5% year-on-year. Digital services are now 45% of the total data business. This is in line with our aspiration to get it to 50%, which will position us firmly as a leading Comtech player. This is an important milestone from where we started 3 years back. Our underlying data revenue growth at 6.6% year-on-year was affected by the macro conditions. Our YTD reported revenue growth was at 15.1% on a consolidated basis. Our YTD reported data revenues are up 20.1% and up by 10.2% from an underlying perspective. As part of our financial disclosures, we are reporting both underlying and reported numbers in line with our commitment to the highest standards of financial disclosure and governance. That said, it is important to recognize that Switch and Kaleyra are being run as an integrated business. For example, Switch and our media is led by one business leader. We've already moved to a structure for Kaleyra, Digo, and InstaCC, where they are in one customer interaction suite unit and led by one business leader. Customer opportunities will be looked at holistically as opposed to looking at it from an individual product lens. Coming to profitability, our efforts have enabled us to report 11.7% growth in Q-on-Q EBITDA this quarter, and I'm encouraged to share that we have been able to fast-track the cost synergies of our Kaleyra acquisition. For Switch, the EBITDA losses have narrowed down further, and we hope to accelerate on our path to EBITDA breakeven. This quarter, the EBITDA margins came in at 20.1% versus 20.8% the previous quarter. The drop in margins is primarily due to the change in revenue mix as the revenue share of digital portfolio keeps increasing. On the subsidiary review, which I talked about last quarter, we are making good progress. We have mutually agreed to exit a large contract in TCTS, which was not profitable, and we will share more on the review as we progress. Now, coming to our segmental performance, our core connectivity business revenues grew by 4.3% year-on-year. To remain relevant and to be the partner of choice for our customers, we continue to enhance our customers' experience by enabling our customers to consume the services digitally. Our digital portfolio revenues stood at rupees 2,099 crores, growing strongly at 78.2% year-on-year and 44.1% Q-on-Q, aided by consolidation of the Kaleyra financials. Underlying digital revenues grew by 11.4% year-on-year this quarter. YTD underlying growth is at 18.3%. From a YTD perspective, except for incubation, all segments have grown mostly above 20%. Next-gen connectivity in particular is up 43.6% YTD, and Collab, which was a drag until last financial year, is up 10.2% on a YTD basis. Our underlying collaboration portfolio grew by 4.4% year-on-year and 3.1% Q-on-Q. The growth is on the back of robust traction in our customer interaction suite, which has offset a seasonal decline in the usage-based revenues this quarter. With the joint capabilities of both Kaleyra and DIGO, it helps us to position as a formidable player. We remain committed to building an intelligent, contextual multi-channel communication solution and creating a customer category of CIS to help us scale growth. We recently enabled Singapore Airlines to transform the airline's communications and collaboration tools to enhance employee productivity and boost user experience. This new transformative initiative delivered on Tata Communications Global Rapid platform will help the airline create new benchmarks and customer experiences. Our next-gen connectivity offerings revenue declined by 1% Q-on-Q and up by 37.9% year-on-year. Our new offerings like Managed Wi-Fi, ISO Multi-Cloud Connect, Flex SD-WAN, and SASE continue to gain traction with enterprises. The case in point is with JLR, where we further strengthened our partnership by deploying our digital fabric comprising of our agile infrastructure, platforms, and managed services that will help integrate JLR systems, workforce, suppliers, stakeholders, and customers across the globe, delivering a seamless flow of data to enrich key aspects of their business ecosystem. Our cloud-hosted security revenues improved by 12.5% year-on-year. Our ISO private cloud, encompassing both infrastructure as a service and platform as a service, grew well above the teens. Our media revenues, including the revenues from Switch, were sequentially up by 0.6% Q-on-Q and 110.3% year-on-year. Excluding Switch, media revenues were up 6.5% year-on-year. Combining capabilities of Switch and our MES business, we are very well positioned to capture the incremental opportunities both in global and regional sports video market, and with a key focus on increasing wallet share from the existing customer base. Moving to our incubation portfolio, we witnessed a flat quarter. Muted growth this quarter is on the back of a large customer implementation we delivered in the same period last year internationally. Our new business continues to grow as we strengthen the segments we operate in while exploring newer avenues. We also continue to stabilize the international opportunities and design wins in the IoT segment to propel this portfolio forward. To summarize, we believe that our digital fabric is a powerful concept which enterprises, especially in the international markets, are beginning to realize. We are confident about the larger opportunity, and with this strong conviction, we will continue to improve and derive value of these organic and inorganic investments and continuously augment our capabilities. With this, I'll request Kabir to share the financial highlights.
Thank you, Lakshmi. Good evening, everyone. Let me take this opportunity to discuss the highlights of our financial performance for the quarter. This has been a historic quarter for us as we surpassed the benchmark of 5,000 crores in our consolidated revenues for the first time ever. Our data revenues continued their healthy growth momentum despite the macroeconomic uncertainties amidst a challenging demand environment. Our reported revenue for the quarter stood at 5,633 crores, improving by 24.4% year-on-year and 15.6% on a sequential basis. Normalizing for Forex, our consolidated revenues grew by 22.6% year-on-year and 15.1% quarter-on-quarter. Data revenue for the quarter stood at 4,618 crores, growing at 28.5% year-on-year and 15.6% on a sequential basis. The underlying data growth stood at 6.6% year-on-year. Revenue growth for our digital portfolio stood at 78.2% year-on-year and 44.1% quarter-on-quarter, driven by the consolidation of the Kaleyra acquisition. Moving to margins, the reported EBITDA margins for the quarter came in at 20.1%, and the underlying EBITDA margins were at 21.7%. Our core business margins, excluding subsidiaries, were at 23.6%. Our absolute EBITDA stood at 1,134 crores, improving by 11.7% quarter-on-quarter and 5.3% year-on-year, aided by a strong focus on driving profitable growth from organic and inorganic investments. I'm delighted to share that we continue to succeed with our Fit to Grow strategy, with Kaleyra turning EBITDA positive ahead of our expectations in the first quarter of consolidation itself, and Switch to making good progress towards EBITDA breakeven. We believe there is room to drive more value from both organic and inorganic investments we've been making, and we see multiple levers to achieve this. Net debt stood at rupees 9,310 crores and net debt to EBITDA at 2.2x, ROCE for the quarter at 21%. Our increased debt levels and sequential decline in ROCE is driven by Kaleyra acquisition. Cash capex for the quarter stood at 630 crores, and the ramp up is attributed to payments coming up from capex projects committed in the prior year, as suggested previously. The free cash flow for the quarter is at 77 crores. These financial KPIs are very much in line with our expectations. PAT for the quarter stood at 45 crores, driven by a one-off provision of 206.6 crores pertaining to a recent apex court judgment regarding the treatment of license fee being capital in nature and not revenue expenditure for the purpose of computation of taxable income. Though the company is not a party to the above judgment, as a matter of prudence, the company has assessed and taken the aforesaid provisions. Moving to subsidiaries, our payment business today has more than 95% of the current quarterly revenues coming from the franchisee model. We have 4,600 plus franchisee ATMs and only 128 company owned ATMs, which with this reversal being achieved in just 24 months, resulting in the business turning EBITDA positive. TCTSL revenues improved by 10.7% year on year due to improving customer engagement and better pricing. We have mutually agreed to exit a large contract in TCTS, which was not profitable, and this will improve the overall business health. Secondly, we have reported revenues from the campaign registry, the information hub that allows us to register messaging campaigns as part of our subsidiaries, and it is being separately managed as a subsidiary as well. This is a business which is part of our recent Kaleyra acquisition. Over the last few years, we have focused on changing the texture of the business to significantly improve the customer relevance quotient and drive sustainable and profitable growth. Our finance strategy of fit to compete and fit to grow allowed us with the elbow room to invest in inorganic capabilities to improve, strengthen our ComTech positioning. To sum up, we will continue to invest in building long-term capabilities, which will help us cement our moats and our long-term ability to consistently create value for our shareholders. I will now ask Chirag to open the forum for Q&A.
Thanks, Kabir. Interested participants may kindly raise their hands for the question and answer session. We will wait for a minute for the queue to assemble. The first question is from the line of Sanjesh Jain from ICICI Securities. Sanjesh, you have been requested to unmute. Please unmute yourself and ask the question. Hi Sanjesh, you're audible. Please go ahead.
Yeah, okay. Thank you. Hello?
Yeah. Hi, Sanjesh, we can hear you. Please go ahead.
Okay. Thank you. A couple of questions. First of all, congratulations on a successful integration and probably a much better performance from the acquisition. So let me start with that. Can you help us understand what are the synergic benefit we had while last quarter Kaleyra was a negative -5% EBITDA margin, and this quarter we have achieved a positive PAT, which is a significant improvement in the performance of the Kaleyra. So one, what are the synergy benefit, and number two, what is the underlying growth in Kaleyra for this quarter?
Yeah, let me take the first part, and I'll come to the growth in a bit. Firstly, let me say integration is complete. We are far from it. We have just started that journey, Sanjesh. So there are three components to any acquisition. The most important one is integration. We have a project management team in place, and which is tracking various milestones in the integration. So that's on track. Then we have revenue synergies and we have cost synergies. What as Lakshmi mentioned, and I alluded further, the cost synergies, we have actually fast-tracked it. We had enough window available for us, even the pre-close itself, to understand what are the levers. To just say it was an SEC regulated NYSE listed company, so alongside came a lot of costs, with that kind of a regulated structure. So obviously we were quick to delist within 10 days of the close, 6th of October. We closed 6th of October, we delisted from NYSE, and there were multiple other low-hanging fruits from a cost perspective, which we were quick to take it out. So I would say that's definitely one lever which we have fast-tracked, and therefore we have now seen that the CIS portion of Kalera has turned EBITDA positive as a result. We continue to have the focus, I would say, on the business to drive the revenue synergies, and of course it is the synergy of growth, the combined portfolio of DIGO, InstaCC and Kalera forming part of the new category that we are creating called CIS, which is what is going to drive the entire thing, and we are quite I would say energized by that.
So Sanjesh, let me add, I think one quarter would be too soon to call a success. I think the teams are extremely focused. We are very excited about the talent that we have of the combined teams. And as Kadir mentioned, we are going through this with a very disciplined execution, right? So this whole integration will take time, extracting all the cost synergies, driving all the revenue synergies, getting all the products and platforms together. We will further invest in making the product more intelligent by adding AI and other capabilities. So we have some ways to go, but we are very pleased with the beginning that we have made.
Great. And on the revenue growth in Kalera for this quarter?
Again, only one quarter, Sanjesh. It's too soon to call out any quarterly trends and so on and so forth.
Fair enough. Now, how has been the switch experience? Because there I can see there is a 25 crore reduction quarter on quarter on the losses. Last quarter was 37 odd crore and we have brought it down to 12 crore. Is it again a combination of cost and revenue, or it is just cost as of now? Because revenue tends to look like a flattish quarter on quarter. While we had a cricket event also in India, I thought that should have benefited us.
Yeah, I think media overall, okay, let me add on the switch again, we are going through the execution on both the cost and the revenue synergies. And as you pointed out, the losses are narrowing, and we will soon be breaking even that and thereon moving forward. From a revenue standpoint, there are multiple things that play as far as the media business is concerned. And switch, we have to invest more on the front end, which we will be doing. So there were some one-off revenues, what they call as occasional use revenues, and that was a long tail. We are consciously looking at the long tail to see, should we be having the long tail or focused on larger properties and larger contracts. And the business is going through that transformation and aligning to what our media business has been doing. On a year-on-year basis, overall media revenues, you would see, last year we had a World Cup which gave us a boost, and that's a year event. Otherwise, there's nothing particular to call out on the revenue front as far as
Fair enough. Just one last question on the acquisition. We have earlier guided that a double digits in margins in Kalera is what we are targeting. With this initial start, do you think that's possible in, say, next 18 months to 24 months?
Yeah, I think we mentioned that, Sanjesh, that we want to be breaking even in the short term, and we said in the medium term we would want to get to double digits, and that's what we will be doing. So, I think we will execute, and we'll let you know as how it progresses. But we'll again, as I said, one quarter is too soon to call out many things.
Okay.
We did say that that's our direction of travel, and that is what we would be doing.
Sorry, my follow-up question on the core business or the underlying business. We have seen this quarter a material deceleration in the revenue growth. 11% growth in the digital versus YTD 18%. If I remove this quarter, we were upwards of 20%. What has led to this sudden deceleration in the growth, and how does our order book looks like for remainder of this year and next year?
Yeah. So again, I will take more a YTD perspective in this, Sanjesh. We have been saying that yes, there is a deceleration in the digital, but that's one is largely attributable to the macro. I think last quarter also you asked the same question, right, in terms of deceleration. Yeah. And I think I answered the same thing. The macro conditions are still not very favorable. So if you look at other companies in the same domain, I think they've called out similar kind of slowdown. The positive that I'm going to look at is with our expanded portfolio, our levels of participation in larger opportunities continues to increase. Our funnel is therefore healthy. I'm taken to is I called out last 2 quarters, not just last quarter, the last 2 quarters. I think it continues to be longer than normal. So I think those are the conditions that we are in. But overall, given the macro conditions, I think our growth is still very creditable, and we are quite pleased with what we have delivered. Of course, we can be doing more. As and when the conditions improve, we are definitely positioned to do.
So any more color on the order book? How do you see it growing? Because we were growing at double digit earlier. Are we still doing that? Because we have invested significantly on the foot on the street, particularly on the international market, product expansion. So this should have significantly expanded our reach as well as the wallet share. I thought it should help us in the vendors right now.
No, it is improving. So our international growth is quite good. I wouldn't say all the regions in the international geographies are firing. I think certainly there are certain markets which are firing very well, and we are seeing a good double digit. One of the markets is delivered upwards of 20%. One of them is just shade below 20%. But all regions are yet to fire. But those investments will pay dividends. And as I called out, with our expanded portfolio, our levels of conversation and engagement with customers are definitely improving.
Thanks, Lakshmi. On that, one last question, probably on the balance sheet side, before I come back in the queue. The cash conversion appears to be quite weak, Kabir, for last 2 quarters, and that is driving net debt higher than our acquisition cost. Is there anything change we are seeing in the cash conversion, along with the decision making getting slower in the deal? Are we also seeing a delayed payment from the customer side?
Sanjay, I'm acutely aware of that. There is no cause for concern there. We did have in the past a lot of tax refunds that the team meticulously went ahead and then collected. So obviously, after a point, that indeed dries up. So there is very little left to skim out, there. So that is one. Working capital, there were indeed challenges in the previous quarter, not this quarter. This quarter is slightly better, although we could have done little more than better than what we should have. Our capex is going up. If you recall, last year when our approved capex was higher, the cash capex was actually lower because of delayed deliveries and better payment terms that the supply chain teams had negotiated. So all of that catch up is happening, in these quarters now, where the cash capex is actually higher than the approved capex. So I would say a combination of all of these things, which is why we are seeing the impact on the free cash flow.
Kabir, actually, there is a lot of disturbance in the background, and sorry, I couldn't hear anything. But I will take it from Rajiv of the record. But I think there's a problem with the audio system.
I mean, not at this side, Sanjesh. I don't know if anybody else. Maybe we'll ask the next, question and figure out if that is a problem. Sorry about that.
Our teams listening in remotely are saying that they have a good quality, so we'll check anyway. Why don't you pick it up, Sanjesh, with Rajiv separately? And Kabir separately.
Yeah. Thank you very much, and thanks Lakshmi, thanks Kabir for all the efforts, and best of luck for the coming quarters.
Thank you.
Thanks, Sanjay. The next question is from the line of Santosh Sinha from Emkay Global. Santosh, you have been requested to unmute. Please go ahead and ask your question.
My question is one regarding trade receivables. What we have seen is that there has been a marked increase from in the trade receivable to rupees 2 billion from 1.7 billion in last quarter from one of the customers. What is the plan of the company actually to recover this receivable, and what is the way forward for this? And second question is regarding the slowdown in growth in terms of incubation in particular. So there has been incubation was down 2% year-on-year basis. So what is the key reason for that?
Let me take the receivables question first. It is there's nothing to worry. It's just the consolidation of Kaleyra. When we actually added the Kaleyra financials to us, we've obviously added all the P&L item and the balance sheet items as well. So the addition of Kaleyra, when you add together, sees the absolute increase in receivables. The days outstanding, which we track as a KPI, is completely under control, Santosh.
Yeah, on the incubation, Santosh, I think I mentioned there is one portfolio which got affected because of a large contract that we had last year in the international region in IoT. That project was delivered, and that saw a bump up in revenue. So Q-on-Q basis, we are seeing that. But other than that move, which is a major part of the incubation, on a YTD basis, we are seeing good growth.
Next question is regarding core connectivity. There also we have seen some moderation means in this quarter 4.3% year-on-year growth versus 7% last year, and also it's actually a decline of 0.7% quarter-on-quarter. So what has led to this core connectivity, and how we can see this in the long term?
See, core connectivity we always call out in the long term. It'll be a low single digit to mid single digits is what we called out. I think last year and a couple of years there was a lot of investment by the cloud providers, the major cloud providers and other CSPs, which helped to drive the core connectivity. Within our enterprise segment, the core connectivity is still holding up. But yeah, that is what it is. So, and at 4.3 is still, I would say, better than what if for the medium term we had anticipated the core connectivity to grow at.
One last question regarding the margin outlook in the long term. So since this quarter, it's better than the margin is better than what we were expecting. How should we see that in the long term overall, the margins going forward? Is there a lot of synergy benefit that will come through, or there will be a means going forward the synergy benefit will not be as strong as we have seen in this quarter? How should we go look at it in terms of long-term margins?
Look, let me remind, our long-term ambition is to stay in the 23 to 25% EBITDA margin range. With the acquisitions that we've done in Switch and in Kaleyra, mathematically, one can do what that impact was. We are slightly, it's just one quarter, we are slightly better than what it would have been because we have accelerated some cost synergies. Having said that, our guidance that in the medium term we will get back to the 23 to 25 range, not just the EBITDA margin, I would say ROCE or net debt, all the financial KPI ranges, will get back to that steady state in the medium term, and we are absolutely on course, to get there. So I have nothing further to add than reiterate that the only goalpost for us on a steady state long-term basis is the 23 to 25 range.
Thank you. Thanks. That's my question.
Thanks, Santosh. The next question is from the line of Gautam Rathi from Chanakya Investments. Gautam, you have been requested to unmute. Please unmute yourself and go ahead and ask your question.
Just wanted to understand a couple of things. Firstly, probing again. I know you've answered a lot on the growth, but Lakshmi, if you just go back last quarter, one of the things you had said was, the slower growth that we saw last quarter was partially because of the slowdown in order booking that we had seen in the H2 of last year. And we had seen much better order booking in the first half. So is it that, some of these orders have been delayed because of the current environment, or how should we read it? Because if my understanding is right, the orders were in the bag and it should have given us much better growth. So is it slower execution of those orders, or is it churn, or what is caused this slow growth?
So I think I mentioned related to last year, H1 we had a good, and H2 had slowed down in the order booking. Slowing down of the revenues. And subsequently, related to the H2, we were seeing good funnel and conversion, but it was not at the same levels of the H1 last year, Gautam, while it was improving. So I think the conditions are still the same. Our funnel still looks healthy. Our funnel additions and our participation levels are increasing. But I would say the overall order booking has not grown so much that we can call out special. Right? So I think I called out last time and even this time in my commentary is that our participation levels are increasing and improving. But the decisions are slower. Sometimes in the funnel, we shelve the opportunities because the customers are taking too long to make a decision, and we are flushing that out of the funnel and starting all over again. But despite that, our funnel looks quite healthy. So I think that only tells me that our relevance to our customers are increasing and our participation is increasing, but the conversion is taking time. Having said that, compared to the internationally, we have seen growth, which is a good indication for us. And relative to 2 years ago, when we saw what our digital portfolio overall was doing, I think last year we did well, and we continue to do well this year. So this is only a reference point compared to what it was 2 years ago. But looking at our ambition is much greater, and we have to do more, and we want to do more. And as and when the macro condition improves, we will be well positioned to do it.
And Lakshmi, the slightly better order booking in H1 versus muted of order booking in H2. I'm just trying to understand: are we on a trajectory where have we hit the bottom in terms of revenue growth, or we could see more pain if the environment remains the way we are today, right? I'm just trying to understand more color on how should we think of trajectory. Are we still in uncertain territories, or are we past the worst is behind us in a way?
It's difficult to say, Gautam. I would think, and if you're referring to our Q-on-Q growth narrative this quarter, that's why I added the YTD growth. If you look at the YTD growth parameters, they are quite decent. So I would read more into the YTD growth and extrapolate as opposed to looking at a Q-on-Q or even a Y-on-Y, because there are some aberrations in last Q3 to this. So all those things I would ask you to look at. If I look at the YTD numbers, while the growth is slower, it is still much better than what the market condition, despite the market conditions we're doing, that is very creditable is what I would say.
And sorry to persist on this, but is it fair to estimate that, going forward, expect YTD to continue to happen and a much more sustainable basis? Because there is a very sharp deceleration that has happened in the 3 quarters, right? 2 out of 4 growth services have reported negative QOQ quarter this time, and I can understand that this can happen sometimes. But is it the right way to think about it? YTD is the right way? Then we can think of it that way going forward.
I would think YTD is a right way to look at it,
Yeah,
because
fair enough.
the portfolio of various things we have, number of things happen.
Fair
But from overall commentary point of view, we are going to be doubling down on our efforts for marketing and sales and all of that. So while at the same time being prudent on cost and driving all cost synergies, and even in our organic business, there's a lot of cost synergy activities that we have carried out even this quarter. So we will manage all of that prudently. But on sales and marketing, we'll be doubling down because we see that we are participating in more opportunities. In fact, in international, our presence is so small that we are not participating in all the opportunities that we could be and should be participating. That's because of lack of footprint. So we have to do more.
Perfect. And Lakshmi, this JLR deal, if you could, give some color that, in our mind, it looks like, this is the first digital transformation deal that you've really called out, right? Where you are your new gen network services, kind of a win, kind of a deal where you're doing it at a global scale. So have we won similar deals, or are there similar deals in the pipeline which you're looking at? And is our understanding right that it is one of those large transformational deals which could be a big growth driver for us going forward?
Yeah, I think there are multiple large deals that we have, Gautam. Sometimes those deals are largely, we in the course of last year, in one of the major European customers, we have displaced an incumbent. Similarly, in APAC, one of the large banks, we've displaced an incumbent with our ISO Internet. I think the reason why we called out the JLR is, while being a large deal, it encompasses a larger part of our digital infrastructure because we already do connected vehicles for them. And this will entail all the network underlay plus the overlay and the security that goes with that. And therefore, we've called out this deal. But these are the type of deals that we are going to market with in the international regions. Perfect.
And the campaign registry business, which is which has been a real standout and a surprise for us. Is it fair to assume that this is like a steady state revenue which could only grow going forward on a quarterly basis, or is there any seasonality that we should be aware of?
Well, look, as I explained, this is basically a business which I think Kalera has done. They're quite proud of building this business in the US. So currently, it's just a US centric business. There are, of course, they are looking at how they want to grow. After a point in time, it is all then led to the number of campaigns that are then run in that country, and the growth is linked to that. But it's a robust business which validates and ensures that it reduces spam for both the operators and the users and the campaign runners as well, so that they bring sanctity into the entire network. So they're doing I would say pretty well, and we are tracking them.
Kabir, just wanted to understand, this is what we've clocked this quarter. It is more or less a steady state number, right? It is not driven by any specific one-offs, or it's not like this Q3 is a very strong quarter for them, and seasonality. And just wanted to get some color, because is it fair to assume that 120 into 4 is more like an annual revenue for them?
Look, again, one quarter don't derive anything out of that. But yeah, if I were to say, like any other business, it is driven by usage and the number of campaigns that are run in that particular quarter. So I really do not have the underlying data of what were the historical campaigns that were actually run, in that country and how much share we have, and therefore, so I would resist from giving a very straight answer of into 4 that you asked, Nishit. But because the underlying nature of the business is dependent on the number of campaigns it runs. It has a fixed fee and then a variable fee linked into it. That's how the pricing model actually works.
Fair. And is it fair to assume that right now it's a US centric business, but you will try to take this business to multiple countries?
Look, it all has a lot of investment linked to that.
Okay.
So yes, one can go, and it's not that easy to replicate the same business in other geographies, because mobile network operators, their systems processes are different, regulation is different. So it's very easy to say, otherwise a lot of people would have already done it by now. Plus, it comes with a huge investment, bill as well. So end of the day, they will stand in line like many other projects, in front of us, and the resource allocation will be done on the ROI that that particular business case generates. So I'm not going to slam dunk and say yes, we're going to expand to 5 countries, because that decision has not been taken.
That's very fair. That's very fair, and that's happy to hear that you're going to be looking at it that way. That's great. Just two more questions. At the one-off that was 185 crores, is that it? Have we accounted for everything, or is there something more to come in that? I just could not fully understand what exactly it was. So it just looks like there was some license fee that was asked for, and you paid for the entire thing along with interest, right? Is that fair?
No, that's not what it is. There was a recent Supreme Court judgment of a large telecom operator that came in October. And although it doesn't pertain to us, we have been prudent to actually take that provision. Basically, in a nutshell, the Supreme Court judgment says that the license fee payable is not revenue in nature for the purpose of computation of taxable income, that it's actually capital in nature and should be amortized over the license period. So what it basically does is it just creates a timing difference. So instead of, and we have done it for the past, 10 years, and prudently taken that provision. So there is no shortfall of tax. The small, amount of shortfall of tax is because of the difference in the effective tax rate in the various years that you actually see. But otherwise, it's just the interest component of having, if at all, that comes to us, then that will be the impact. Going forward, until there's a resolution to this, there will be a true-up of the interest, that will happen. So to that extent, you will in subsequent quarters see a true-up of the interest.
Okay, perfect. Thank you. And the last thing is AGR, right? Is there any update on that? Anything that we should be? Is there any chance of that liability coming up anytime soon for payment?
No, I mean, if it is coming up for payment, then we wouldn't have recorded into contingent liability, Nishit. Whatever updates are there in AGR, we are reflecting that in our accounts. If you see, in the last 4-6 quarters, there has been, a lot of activity. There's been the DOTs looked at our numbers. We have represented to them that there were errors on the face of it. And that's the reason why you see numbers going a little down. In fact, this quarter is because the department looked at the obvious errors and revised their show cause notices. We still maintain, our stand that this is not applicable to us. This is sub judice, and therefore, whenever it comes up, we'll take it. But till the time it is sub judice, what at least we did not want is not have wrong numbers, into the show cause notice and demand notices. So that we've been working, I would say closely with the DOT to ensure that they put in the right numbers, and we agree the principles in which they put, so that we know what principles we're going to contest when this comes up in court.
No, that's very fair, Kabir. Thank you so much. Thank you so much for patiently answering all our questions. Thank you so much.
No worries. Thank you, Nishit.
Thanks, Nishit. Thanks, Gautam. The next question is from the line of Daria Nominik from 91 Investments. Daria, you have been requested to unmute yourself. Please go ahead and ask your question. Daria, please go ahead and ask the question. Daria has left the queue. The next question from line of Mr. Vineet Manik from Karma Capital. Vineet, you have been requested to unmute. Please go ahead and ask the question.
Hello.
Yeah, Vineet, you're audible. Please go ahead.
Yeah. So thank you. Most of my questions have already been answered, but Lakshmi, just one question to you regarding AI. So anything on that development are we doing? And do you expect any material business coming in for us in the next 6 to 12 months based on the developments? Because we have been going through few reports and news articles saying that a lot of activities happening on the telecom side of the business also. So any material advantages are we seeing and are we building on such capabilities?
Yeah, we are building on capabilities, Vineet. I think this was part of our strategy 3 years ago. Starting from training people, so we trained over 1,000 people in the company. We already are seeing AI deployed in some of our processes and products, which we have taken to market. And we also are examining, because this whole AI, especially after the chat GPT, the Gen AI has become quite popular with enterprises. So we anticipate that this is going to require a lot of computing power, and therefore we will enhance our cloud capabilities, the ISO cloud capability that we already have, and enhance it with AI capabilities.
Okay. Got it. And just one bookkeeping question to Kabir is that we have seen a significant QOQ increase of around absolute 50 crore rupees in the interest cost. So is this something that a peak that we can expect, or is it a steady state run rate that we can expect going forward? Or and is there any one-off forex component or something in the interest cost? Because versus the net debt increase, the interest cost seems to be much higher.
Well, we have assumed the net debt of Kalera. As you all know, we paid about 100 million for the equity, and whatever was the debt of Kalera, we have assumed, and so therefore that impact, will come through. At the moment, the Kalera bondholders had a change of control clause. So when the bonds, when the change of control happened 30 days from that, they could exercise, and they exercised, and the entire $200 million of bond was repaid. We have therefore used our short-term facilities to cover that, and hopefully we will recycle that with a more medium to long-term, instrument. So what you see as of now in this quarter is just that addition and that interest cost as a result of that. Associated, with that as well is the Fed rates that you actually see that have been, increasing even in the last quarter also, that the increase has happened. So therefore the benchmark rate has gone up. We have a certain portion of our debt which is hedged, but there's a certain portion that is actually open, and that's in line with our interest rate management and hedging policy. So whatever you see is the residual bit is as a result of that increase in interest costs as well. I can't comment whether that will remain the same or not, because of the refinancing that we will do, hopefully at a lower cost on the 200 million, plus any other financing requirement that we will have, or any other cash flow changes that we will do, which may mean we will reduce it. So our ambition, as I said, is to operate under 2x, and hopefully we should get to that metric faster, than the EBITDA and the ROCE metric. So therefore, if that comes faster down, then the interest cost also should, reflect that. But these are all very, very, dynamic things with a lot of moving parts. So I can't give you a handle on that, on the interest cost per se. But those are the drivers for this current quarter.
Okay. Got it. Thank you for answering my questions.
Thanks, Vineet. The next question is from Arvind Chetty from Diamond Asia Capital. Arvind, you have been requested to unmute. Please unmute and go ahead and ask your question.
This is more on Kalera. Assuming that you've reported Kalera revenues in the collaboration and CPaaS vertical, my calculation suggests that Kalera revenues on a YOY basis for this quarter has sort of declined significantly from what they reported in December 22 quarter. Is that a fair calculation?
No, it is not the right way of calculating, because what you see is publicly reported, including the campaign registry business, which we have called out and reported as part of our segmental performance. So it'll be difficult for you to do an apples and apples comparison that way. Our collaboration portfolio includes CIS, other aspects of DECO and InstaCC as well. So let me assure you, it has not declined.
Sure, thanks. And on the reported basis, in terms of EBITDA margin, since the integration, a fair level of integration has been done, is it fair to assume that on reported basis, the margins will see sequential improvement from here on?
Let me reiterate. I don't think neither Lakshmi or I said the integration is done. We just started on the integration, and we will keep a laser focus on doing the integration well. I mean, for me, doing that well is more important, and then doing on time and maybe ahead of time is the next thing that we'll look at. What we have highlighted in this particular quarter is one aspect of the integration, which is the cost synergies that have been fast tracked, right? And therefore, we have a line of sight and a trajectory on the EBITDA improvement, which we have said that in the near to short term we will do break even. It has happened the first quarter itself, so we are happy about that. But in the medium term is when we will actually get it to the double-digit, EBITDA margin profile, and we will stay focused on that. And the reason why I'm reiterating that is there are investments that need to be made as we do the integration in the product organization, in the infrastructure, and the platforms that the combined portfolio needs. We don't want to rob them off and not achieve the revenue potential and the capability that the entire CIS platform has got if we myopically get driven only by the EBITDA and profitability. Not to say that there is no focus there, but clearly we need to balance both of them together.
Thanks, Arvind. The next question is from the line of Vibhor Singhal from the Nuvama. Vibhor, you have been requested to unmute. Please go ahead and ask your question.
Yeah.
Please go ahead.
Yeah. Hi, thanks. Thanks for taking my questions. A couple of questions from my side. So one question is for Lakshmi. Lakshmi, many of the IT services vendors that have reported results this quarter, they have talked about some green shoots appearing in the overall US macro. Your sister concern mentioned about BFSI bottoming out. A larger corporate mentioned about green shoots in discretionary spending. Now, I know there is a huge difference between the kind of clients and the work that we do. But when you mentioned that we had the growth in this quarter and the overall macro environment had been tepid, are we also seeing some kind of conversations with the clients which are kind of hinting towards maybe things improving, maybe if not in terms of the timeline, but directionally things improving for those the tech spends going into 2024?
Yeah, I think I would definitely say overall, as all macro parameters have shown, the US market is definitely an improved condition. From our customer and our perspective, we are seeing funnels developing there. And as I said, in our case, it's very different, right? In different markets, we have to invest and increase our footprints. In the US, we have to do more, and which is what we will be doing. But overall, the commentary that you heard is accurate. And I would not want to pick out, because our international presence in many markets are fairly small. And anything is a big upside for us. So truly speaking, other than the slowness in decision, the macro shouldn't be affecting us too much.
Right. So apart from the delayed decision-making part, which continues to be at this point of time, maybe same as it was a quarter ago, other than that, the weak macro shouldn't be too much of a problem for us.
No, it shouldn't be.
Got it. Just one last question for Kabir. Kabir, I think you just mentioned about the interest expense going up because of the short-term loans that we have taken for the acquisitions. So I think it's clearly visible in the numbers as well. So I mean, at this point of time, I mean, the average cost of debt that we say as a report is around 6.5%, 6.3%. What is the target that you're looking at in terms of refinancing? Where do we eventually want this average cost of debt to hover around on a sustainable business model?
If you actually look at, we have a debt equity, structure that is defined for us, an optimal WACC, and that's the reason why we talked about debt to EBITDA, being under 2x. So that's the optimal WACC, level that which I would like to operate under. And I'm going to, answer the question by giving you the contours, of our approach rather than pointing that, because the context and the numbers and this might change, and therefore the number might change, and that's the reason why it's important that we marry to the principle, right? So we are committed to an optimal WACC. I'm also want to stay committed to an investment grade kind of rating. So therefore our coverage and service ratios need to fall within that ambit as well. And we have a hedging policy which looks at giving certainty to near-term P&L, and therefore hedging a large portion of that. So currently about I would say 60% of our current loan books is hedged. And finally, in terms of refinancing that you actually mentioned, when we did the NCD issuance back in August, although our requirement was in US dollars, we did borrow because there was an arbitrage that was available in the Indian markets. So we borrowed in Indian market and did a cross-currency swap. And the landed cost of that was much cheaper than doing it directly in dollars. So the treasury team constantly scans the market, is in constant conversations with our banking partners to look at the right opportunities where we will actually do that. So that's the reason why when we did not have certainty whether the Kalera bondholders were indeed tender all their bonds, so we just established a line of credit in early December when the bonds came up for repayment. And now we will examine what is the right structure, right market, right currency for us to be able to do the medium to long-term funding to replace this short-term, in line with our treasury policies. That's which I just explained about. So those are the contours with which we will operate. Not just this, but I would say there are several other BAU that we have in terms of funding BAU capex, monetization, activities that we do, organic cash flow generated by the business, and everything put together. So that's the whole cash projection and cash analysis with which we review this almost, I would say, with the hedging strategies reviewed on a weekly basis with the dynamic market situation that we have. But all of the other things are reviewed almost on a monthly basis.
Got it. Thanks a lot for that very comprehensive answer. Just one small bookkeeping thing. I'm sorry if I missed that. I think you mentioned that. Has all the debt related to the Kalera acquisition is in our books already, or there is some still pending amount that might come in the next quarter or so?
No. The entire thing is in our books. So the full balance sheet has been consolidated and balance sheet has been taken. So the full thing is already reflected in our results.
Got it. Thank you so much. Thanks for taking my questions, and wish you all the best.
Thank you, Vibhor.
Thanks, Vibhor. In the interest of time, we will have one more question as the last question from Sanjesh. Sanjesh, you have been requested to mute. Please go ahead and ask your question. We limit this to one question, please.
Yeah, thanks. Thanks for taking my question again. One on the employee side, I wanted to understand, you did allude, Lakshmi, in your initial comment that you want to repurpose the employees from both Switch as well as the Kalera to cross-sell the Tata Communication product.
Yeah.
So is that agreed by the employees, and what are the areas of focus for us through those employees to target in the US market? What are the key areas of focus that will drive that? And will they work along with the foot on the sales we have increased? How will that organization structure work?
It's probably too soon to announce externally the new structure that will be put in place, Sanjesh. But as I mentioned in my commentary, they are all working under one business leader, right? So Switch, for example, is the sales teams are completely integrated. They take the offerings in a joint way. Both the teams are working together to bring the power of both companies. Similarly, in Kalera, we are looking at the sales teams to operate as one as opposed to two different teams. And as we speak, the training for the teams have started on the various offerings within the CIS portfolio. For example, InstaCC is a portfolio that Kalera does not have. So the sales teams are being trained on that. That's what they will take to market. Whether the Kalera teams will take the overall Tatacom offerings, they are not capable of doing that, but they will work in an integrated fashion with our regional teams to look at what are the common accounts, which are the accounts where Tatacom is present and they are not, and vice versa, right? So which is what we called out as sales synergies, which we will start looking at, and that activity has already started.
So we will have both vertical and horizontal structure because this appears to be more vertical, while I thought we were moving out of vertical to a more horizontal solution, let's say, kind of an organization structure. There is a change in that, right?
No, not really. So even within the Tatacom portfolio, if you look at, we had what we call as the products sales specialists. So if you look at InstaCC and Digo, in the markets where we were operating, both in India and APAC, for example, we had a sales specialist team who will focus only on InstaCC and Digo, for instance, right? They will work hand in hand with the account teams and the regional teams, because they are the specialists in that portfolio. Now, the account teams are charged with understanding the customer context, and they will position the overall digital fabric, whether it's the network, whether it's security, whether all the portfolio that we have. But once the opportunities are qualified, these sales specialists will go in to support the account teams to take the opportunities forward and close it. In terms of Kalera, so Kalera would be the sales specialist for the CIS portfolio. So it is not any different from the philosophy that we've been operating in.
So that two-layer of structure will continue, and that's what we are implementing for the new coming companies as well.
Yes, yeah.
This also means that in upcoming year, our employee inflation will be lower than what we had historically, right? Because we are getting a very talented foot on street to these two acquisitions. Will that be a fair assumption?
No, why do you see? I think each of the, if you look at Kalera's existing business, that has to grow. So they come with that talent to sell that portfolio of CIS, right? So they will support. Whereas the sales team, which covers a larger set of accounts and hunting for new logos, we need to continue to invest as we grow. So I don't think this would make up for the future growth, if you will. Yeah.
Fair enough. Thanks, Lakshmi, for answering all those questions, and again, best of luck for the coming quarters.
Thank you.
Thanks, Sanjesh. I'll now request Lakshmi to share his closing comments.
I think we've answered a lot of questions. No, I think my top of mind is we've crossing the 5,000 crore mark and crossing the 4,000 crore mark on the data business is truly a milestone that we are all very proud of. I think we are very proud of the activities of integration that is going on, and we will execute all of this in a very disciplined manner to deliver on our ambitions of doubling our revenues and achieving all the other financial KPIs. I think this sets up us very well. Thank you.
Thank you, Lakshmi. This brings us to the end of the investor call. In case of any queries, please write to investorrelations@tatacommunications.com. The recording will be available on our website in the next 24 hours. You may please disconnect now. Thank you.